Hello, and welcome back to Reflections on Investing with the Cornell Capital Group. And with the market having fallen over the last month or so, there's a lot of attention on have we hit bottom? What is a fair level for the S&P 500? And there's really only one way to assess the fair level of an investment, and that is in terms of the cash flows that investment can be expected to produce. And no one's been a better and more thorough advocate of this than my former student, current colleague, and occasional co-author, Aswath Damodaran. And he has a particularly good post now on his musings on markets, where he attempts to assess the fair level of the S&P 500. So what I'd like to do today is walk you through the thinking behind it, not necessarily his numbers or even his final conclusion, but the process he uses is precisely the one that finance theory suggests is the right way to go. And if you go back to one of our earliest reflections on the fundamental investment equation, you can see why that's the case. So now we'll focus on applications. What is a fair level for the S&P 500? So let's go over to the computer and get started. And all this is taken from Professor Damodaran's Musings on Markets, which he posted on September 26, 2022, at which time the closing price of the S&P 500 was $36.93. Now, in order to get to future cash flows, Professor Damodaran rightly starts with earnings. And in 2021, the historical earnings on the S&P 500 stocks were 208.53. But what we want are the earnings going forward. Professor Damodaran begins with analyst forecasts, consensus analyst forecasts for future earnings, but he doesn't stop there. He thinks there's going to be a recession in 2023. So we see here his forecasts of future earnings. And based on those forecasts, he can compute the growth in earnings. This is just a computation. Now, earnings are not cash flow because companies may retain earnings. So you need to worry about the payout ratio. How much of the earnings will be paid out as either dividends or buybacks? And Professor Damodaran believes it was going to be 90.5 when this year is done, but it's going to decline down to 80% by 2026. So when you multiply the payout ratio by the earnings, you get the cash flow. Now there's one more trick here, the so-called terminal year. He has forecasts for each of the next 5 years, but the S&P 500 isn't going to go away 5 years from now. So what he does, and what is commonly done by most investment bankers, you project the earnings one more year, and then you assume they're going to grow at a constant rate. And Professor Damodaran uses 4% as the long-term growth rate. And with those two numbers, you can compute what's known as the terminal cash flow. That's not just for the 2027. That's for the indefinite future as the cash flow grows at 4%. And that cash flow comes to $4,207.49. Now, one of the basic principles of finance is when you have cash flows in the future, they aren't worth as much as the present. They have to be discounted back. And for stocks, the discount rate depends on two things. The risk-free rate, and Professor Damodaran and most analysts use the 10-year Treasury rate, and the equity risk premium, which is the amount of added return over the 10-year Treasury that investors require in order to hold stocks. And you can see Professor Damodaran's projections. The interest rate rises from about where it is now, 3.75 to 4%. The equity risk premium stays constant at 5%. You add those together and you get the rate for discounting the future cash flows. From here, it's all arithmetic. You apply the discounting arithmetic to get the present value of the cash flows discounted at the discount rate shown. And this column does that calculation. And it shows that the sum of the present values is the fundamental value of the S&P 500 index based on the projections of cash flow from earnings. And in Professor Damodaran's case, it comes to 3,515 compared to the actual of 3693. So he felt at the time he posted the market was about 5% overvalued. Now, if we want to update it, we're recording this on Sunday, October 9th. If we want to update this more currently, on Friday, October 7th, the market closed at 36.39. So if I put that in, that's lower. The percent overvaluation drops to 3.5. I mean, given all the difficulties of forecasting earnings and payout ratios and discount rates and so forth, there's clearly going to be some margin for error. So a 3.5% overvaluation is really equivalent to saying this calculation based on Professor Damodaran's numbers means that the market is about where it should be. Now, of course, you can go back in, and I urge people to do this. Change the earnings forecast, change the payout ratios, change the discount rates, and you'll get different numbers. But this is the only underlying scientific way to assess the level of the S&P 500 index. So I hope that gives you some insight into how you can evaluate the level of the S&P 500 index and maybe some comfort that it is not wildly overvalued. But once again, I urge you to do your own analysis. It's the only way to evaluate the level of the S&P. This has been Reflections on Investing with the Cornell Capital Group. Thanks for joining us.